with Brian Moynihan, the Chairman and CEO of Bank of America. Brian, good morning.
Good morning, Will.
Thanks very much for joining us. Before we get into the meat of Bank of America, I just want to ask you to react to that clip you and I just watched together of Donald Trump, specifically criticizing one company, Boeing in this instance. We saw direct negotiations from the president with Carrier and UTX last week. Are you prepared for that to happen for Bank of America, direct president to CEO negotiations? And what do you think of that sort of management style from the president?
Well, I think the management style, the involvement, I think people welcome just because it means things will happen, but it's not new. I mean, I think we had an episode 5 years ago where the president of the United States criticized us for charging a fee and things, so it's not new for it to be reflected upon. With banks, it's a little bit different because of the regulatory environment. You have a different set of people who are in with you all the time. So, it's new, but I don't think it's as new as people think, and I think it'll play out based on, as your team said, based on what will really happen.
Mm-hmm. Let's talk about that regulatory environment, and specifically Dodd-Frank. Jamie Dimon, just talking downstairs moments ago, said, "We're not asking for a wholesale change to Dodd-Frank, but it's always rational to look at these things again." What's your take on deregulation that's likely under Donald Trump, President-elect, and what Jamie Dimon just said?
Well, I think Jamie and a group of CEOs that work in the industry, we all look back at what went right and went wrong in the late 2006, 7, 8 as a crisis built up and what had. And so adding capital, adding liquidity, simplifying your company, focused on what the core purpose is, those are all good things. And the CEOs that run these companies, large, medium-sized, or big, all believe in that. And so what we're not saying is let's go back to where we can have these problems, the people outside our industry that are doing things that then the industry has to clean up. Let's go back to doing it. We made those changes a long time ago, and I think, so there's a lot of debate about what the right course forward is, but the clear thing is let's be careful about it because we're self-interested as an industry. We have a obligation through the FDIC to pay the costs to clean up, and so we want reasonable regulation, and we think it's appropriate.
So we're not expecting a wholesale change in the regulation, yet your stock is up 29% since the election, a meteoric rise in such a short space of time. Is that justified, that move? Is Donald Trump really that good for Bank of America?
Well, I think if you think about two parts in time, one is in the lead up to the election. If you take our third quarter results and you saw the fundamentals coming through for another quarter, the expenses continue to be managed down, the revenues lifting, the activity coming through, and the issues in the past that had cut up our earnings, some all behind us. And so I think that was a good base, and we were up almost 8-10% leading into the election. And the election then basically focused people on a few things. Faster growth, that's good for Bank of America. A higher interest rate structure, that's good for Bank of America. And then investors in particular were skeptical of the issue that every time we think our industry had crossed the regulatory threshold, got to the hurdle rates on capital, built the liquidity, that there was another hurdle placed in front of them. And I think that investors have been responding thinking that won't happen with as much volume as before. And therefore, we can start to get to the capital and release it back to the shareholders or make more loans and help drive that economy. So if you think about those types of things, it's no surprise that we've pushed up hard.
There's one other area which I think has perhaps been less spoken about in the last couple of weeks, but I've heard a lot today here at the conference, which is the prospect for more M&A, particularly when you consider the chance of foreign cash being brought back into the US. Is that something you're increasingly positive about, that we could see that pick up significantly next year?
I think that you'll see. I think our people think we'll see more M&A. As Bank of America, we can't do an acquisition; it's illegal in the United States. So that makes my life easy. I don't have to worry about it. But as a provider of services to other companies, people, the animal spirits, so-called, the view of people saying, "Hey, I think I can see forward with more duration. I can understand it." And also, we're still in a low-growth environment. One of the ways M&A helps you is to consolidate companies and get synergies out of them in lower-growth environments. So even if growth picks up a little bit, the top-line growth, for big companies largely exceeding the GDP growth is hard. So therefore, they're going to be looking for ways to create more value for their shareholders. So I think that's absolutely right. And in our industry, in banking, the belief is things could move. It's not relevant to us as a principle.
Jim, we've got Brian, excuse me, we've got a question or two from the studio. Jim Cramer coming up next. Yep. My apologies. Jim's coming in with it, Brian.
A couple of things, Brian. One, I know that as rates go up, it's terrific for Bank of America. Two, if we get rate hikes, it's great. But also, oil's come up. I know you had some loans that you talked about that were criticized, but maybe they come back. Is this just that one of those moments where the reason why the stock is well in advance above its book value is that you've got tailwinds galore?
Right, Jim, I think that's right. And I think you got to juxtapose that against the headwinds that we'd had over the last several quarters and years where we had cleaning up legacy issues. The economy was considered to be lower growth, and the issue was it was to be even lower growth, and rates seemed to be going nowhere. So you reverse that, and they all tailwinds. Same facts with a little bit of optimism, glass half full, produced tailwinds instead of headwinds.
Brian, we know a lot about your investment in technology in recent years. Is that something you're really seeing the benefits of now, with the investment behind you and the benefits to come? And how many more stores, branches might it allow you to close over the next 3 or 4 years?
Well, when we think about technology investments, think along a couple categories. One is better products for consumers and customers, commercial customers and investing customers. The second is productivity, and productivity has 2 broad stripes to it. One is people productivity, or people can do more. And the second is largely around the efficiency of operating a platform. So less data centers, less architecture around that, the way you develop and stuff. And we're making gains in all those areas. So if you think about in our computer backbone, the cloud for our company, the internal cloud, we've taken out about $400 or $500 million in savings, and we expect to take out $400, $500 million a year out of a $5 billion base over the next several years by continuing to consolidate data centers. So there's just a lot of room ahead of us, and there's basic paper to electronic. We still have a lot of paper. Cash to move around our company is $5 billion. The minute we move a payment to electronic, we save some small portion of that. You just have to do it over and over. So technology to make that happen. But never forget, on the front end, it's better feature functionality for the clients and customers, and that's what we're driving.
In terms of the top line, we know it's expected to pick up. We've talked about some of those tailwinds, and Jim mentioned some of them. Where's that going to go, though? Is it going to be straight to the bottom line? Is your forecasts for cost, the aim of $53 billion, is that target still the same? Or as the top line picks up, will we actually see the cost line pick up a little bit too?
If it picks up, it's not going to pick up. We have $53 billion. But what puts upward pressure on costs are the classic things. More incentive compensation because more client-driven activity, and then inflation. We have healthcare costs of $2 billion a year, and that goes up. And so what you have to do is manage the rest of the cost to make that flatten out. And so if you think about it, we're saying we can go from about a $55 billion run rate today to about 53. At the same time, we're making the investments you're talking about, absorbing those inflationary costs. And so you have to be able to walk and chew gum. You have to be able to drive the top line. That will put cost pressure on those issues. At the same time, you're bringing it to the bottom line. Rate structure all moves the bottom line, basically.
And so for the most part, you've positioned yourself in the recent 5 years, and you're ready to now enjoy the tide as it gets lifted, as it were.
Yeah, and the rate structure, remember, is not something we did to position a company. It's just the basic business model. We have $1.3 trillion of deposits. Half of the $500 billion of them are interest-free. They don't change when rates go up, but they become more valuable while your cost of funds stays down. And that's been a long time coming. I mean, the Fed's fund rate has been basically at 25 basis points, up, and then recently, last year, this time moved to 50. So that change is very valuable to companies. 60% of the value of a rate move for 100 basis points is due to the front end. And so we didn't decide we were going to run the company. The business model leads you here, and it will produce more, and that will follow the bottom line going forward.
Just quickly wanted to ask you about Trump's Strategic and Policy Council. Were you asked to be on that as well, or not?
No, I'm not on it now.
And there's quite a lot of Goldman Sachs alumni in the cabinet. Jamie Dimon made it onto the Policy Council. Do you feel left out on that? Is that a strategic disadvantage for you not being on it, on those things?
We have good advocates on that council from all the people on it, that the points we made. And tomorrow we have the Business Roundtable, and a few weeks we'll have the financial services teams get together. So the idea is that most of the industry speaks with a single voice, so we just need to get our ideas on the table about things we can do to help the real economy grow. This is what it's about. Whether it's a Business Roundtable, whether it's a Chamber of Commerce, whether it's the various trade groups in the financial services, it's about how can we help the real economy grow. That is our job as a bank, and that's our job collectively as a bank. So those teammates, those colleagues of mine, they'll speak for us. I don't think, if we have 100 people in a room, we're not going to get a lot done, so we'll make our positions known, but they're very similar across the industries.
Just a quick comment to round things off on Italy. Referendum went against the establishment again. Is that another factor that allows you to take market share in Europe?
Well, I think Europe is just in a constant set of election outcomes that are, this one's probably less expected, but it was still less expected if you went back 6 months or a year ago, and I think that we just have to be mindful that it continues to cause uncertainty in Europe, which slows down the economy, although the numbers out of Germany were strong, and I think the euro being down will help. And so I think this will work through, but it is a very complex system they're working through with all the different countries and all the different points of view and any election cycle proceeding that we've all got to be ready for. And so whether it's the UK Brexit, whether it's the Italy referendum, whether it's impending French elections, these are all things that we have to position our company to be insulated from a really negative outcome and then just help the people through the other side of it.
Brian, a pleasure as always.